Welcome to this JD Power webinar, Residual Value Outlook 2026. What's next for Europe's used car markets? I'm Tom Hooker, Content Specialist at JD Power, and I'll be your moderator today. As economic and geopolitical uncertainty persists, Europe's automotive industry and its used car market remain under renewed pressure. With residual values continuing to normalise, forecasting the second half of the year may seem straightforward. However, if you look a bit deeper into the data, you'll see some crucial trends only just beginning to emerge. Today, we'll give you a full picture of what to expect for the remainder of 2026 and reveal how headwinds are shifting the market. On that note, it's time to introduce today's panel. Jason, could you start us off? Let us know a little bit about yourself and what you're most looking forward to explore in this session.
Thank you. I'm Jason Whittington. I'm Regional Head of Valuation, covering the UK market, the Nordics and Australia. This is my 30th year working within the motor industry in the UK. What am I most looking forward to? I'm kind of looking forward to looking back at our recent past to see if there are trends that we can use moving forward.
Excited to see that. And Anna, I'll pass things over to you now.
Yeah, good morning, Tom, and good morning, everyone. I'm Anna Zofra, Regional Head of Valuation and Insights for South and West Europe. And today we will look at how the market has evolved during the first half of the year, whether we are seeing a shift in the current trend, and of course, our outlook for the next 6 months.
Thanks, Anna. And Robert, last but no means least, over to you.
Good morning, everybody. My name is Robert Madas. I'm Director of Valuations for Europe and Australia, and I'm looking forward to exploring how macroeconomic trends are currently impacting the automotive industry.
Thanks, everyone. So what can you expect from today's webinar? Well, firstly, we'll be exploring some key macroeconomic trends that are impacting the automotive industry. Then we'll look at the dynamics shaping the used car market in 2026 and what's in store for the second half of the year. Following that, we'll take a deep dive into the UK, one of the largest and most distinct used car markets in Europe. And last but not least, we'll have our Q&A section. You can submit your questions at any time during the session using the Q&A box in the GoToWebinar platform. And if we don't have time to answer your questions during this session, then please don't worry, because we'll be following up with you afterwards. And one final note to be aware of: while we won't be sharing the slides from this webinar, today's session is being recorded, and you'll be able to find that recording over on the JD Power YouTube channel. So let's begin with a quick question for our audience. How do you expect residual values in major European used car markets to perform by the end of 2026? To get involved, you can scan the QR code on the screen or use the link that's just been pasted into the chat. Now, there's 3 options you can pick: either that you expect a decline, a decrease, or maybe that you expect some stabilization. So get involved and let us know your thoughts, and we'll be revealing the results later on in the webinar. But for now, I think it's important to set the scene for a second, as we usually do in these webinars, because the environment in which the latest residual value outlook was made has significantly changed since the start of the year. Robert, what macroeconomic developments do we need to be aware of here?
If you look at the global economy, we can see that it entered in 26 with a stronger momentum than expected, and it remains quite resilient. But especially in Europe, there is some slowdown amid higher energy prices and geopolitical uncertainty. The energy market disruptions have actually weakened the outlook in Europe. We can see this on this chart by the red icon next to the figures. The bar up is the bar from 25, where we had a growth in Europe of 1.4%. For next year, the forecast is 0.8%, and then a modest recovery in 27 to 1.2%. So there is some prolonged disruption to energy supplies that could result in weaker growth even. So this is some risks the OECD have highlighted recently. Higher energy costs, increased uncertainty, and weaker consumer confidence, they are waiting on investment decisions and also on household demand. Meanwhile, if you look into other regions like the USA and China, we can see that for the year 26, the outlook has even increased slightly to 2.0% in the US and 4.5% in China. So to summarize, there is still global growth expected to recover slightly in 27 as energy markets stabilize and confidence is expected to improve. However, there are downside risks that still remain elevated.
So tell us then a little bit more about these downside risks. What are they exactly and how have they evolved in recent times?
In Europe, specifically, this is the recent inflation rates. So on the left-hand side of this slide, we can see the trend of inflation rates starting January 25 until May 26. And we can see that after some stabilization and inflation coming down during the year 25, generally speaking, now in 26, we have a situation of increased inflation pressures again, up to 3.3% in May in the EU. And also the latest figures for June show some easing inflation to 2.8%, but still on the high side. So it's a higher level than the European Central Bank's, let's say, suggestions. We would return to the target, which is 2.0%, not before 28. So there is some higher inflation pressure currently due to the energy supply crisis, because energy inflation rates, they have picked up to a level of 8 or 9%, depending on the market we are looking in. So that's a really important influencing factor. And this translates then, if you look on the right-hand side, to an elevated consumer price index. So the consumer price index measured in points is well above pre-pandemic levels. And again now, with increased inflation rates in Q1 and also Q2 of this year has risen the CPI index. So overall, the economic outlook has become a bit less favorable than anticipated earlier, and the energy shock has weakened growth prospects a bit, and this is one of these elevated risk factors I was referring to before.
And with this less favorable economic outlook, what has the knock-on effect been for Europe's automotive industry?
So the sector largely moved now beyond the post-pandemic disruption phase into a phase of weak economic growth, inflation on a quite high level, and geopolitical uncertainty. And we are in a phase of technological transformation and also of intensified global competition. If you look at some of the market factors, we can see on the demand side, new car registrations have recovered modestly, so there's some stabilization. However, it is subdued and generally expected to remain in a single-digit range growth. Geopolitics, we've talked about this already, and trade conflicts have evolved rather than disappeared in the first half of 26. There are trade tensions, there are geopolitical risks in terms of energy supply. So there have been some ease in the trade conflicts, but still it means supply chain localization is being looked at, and there is persistent uncertainty affecting the automotive industry. When we move to the emission regulations, we've talked about this in the last RV webinar. There is some flexibility introduced in Europe. So now the reduction target is an average of 3 years, 25 to 27. However, the reduction target remains in place. So it's still some volume push caused by this regulation and leading OEMs also to provide incentives on low emission vehicles. Generally speaking, the EV market and technological advancements show that the portfolio is really in transition. Chinese competition intensifies. So we see here entering different markets of Europe, increased competitive pressure on established European OEMs, competitive pricing from this competition, but also advanced software features and product advancements here. This leads then to profitability pressures. So there is this pressure from price competition that I have mentioned, but not only from price competition, there are also huge investments necessary from the industry with regards to the portfolio transition to emission reduced vehicles and the transformation costs as such. So in summary, the European automotive industry has transitioned to a structural transformation now. And this is amid a situation of geopolitical risks and some uncertainties with macroeconomic factors. And this will stay with us for some more time in the automotive industry.
And have these developments already affected the used car market in the first half of 2026?
Looking at the big five markets and how asking prices for up to 8-year-old vehicles have developed, we can see that used car prices have stabilized in the first quarter of this year, but now are under increasing pressure again. This is expected. So we can what this reflects here is on the one side the supply and demand situation. So there is more supply coming to used markets because new car registrations have improved in the last 3 years from year to year slightly. However, there is the macroeconomic impact that I discussed before, also putting pressure on used car markets. So this is viewed from our point of view as a continuous normalization of the markets and the supply and demand factors coming more and more into balance again. Having said that, the effects can be quite different if we look into more details like fuel types or individual markets, but I think we will explore this a bit later in the webinar.
We certainly will. Yeah, we're going to be looking at how these factors have really affected Europe's residual value outlook, not only by country, but also by powertrain as well, and seeing whether this is trending in any unexpected directions. But before we come on to that, just a reminder that you continue to submit questions to our Q&A, and I can already see that we're getting some fantastic questions coming in, so please continue to do so. Okay, Anna, with the used car price index falling across major European markets, are we seeing the same situation with residual values?
Yes, sure. As Robert just mentioned, the first half of the year has developed largely as expected, with the market adjustments we anticipate. And the chart on the left, extracted from our residual value intelligence tool, shows the average residual value in percentage, using as a reference, as usual, trade values, 3 years old cars with 60,000 kilometers, and we see a gradual downward trend across all markets. But as we always insist, and Robert also did it, this is a continuation of the normalization process that we have been highlighting for some time, following a few years in which residual values rose to exceptionally high levels. It's fair to say that overall trend across Europe has been one of stability, where Spain continues to lead the way, the yellow line, with residual values remaining strong, but also in other markets, the adjustments have been relatively modest. Only 2 markets stand out, where the correction has been more significant: the UK, the red line, with -4 percentage points, and Italy, the green line, with -3 points. In the UK, this reflects not only some oversupply in certain powertrains, but also the typical seasonal effect we see as we approach the summer months, when residual values tend to soften. But my colleague Jason Whittington will cover the UK market in much greater detail later in the presentation. And Italy is a different story, and it's something that we have highlighted in previous updates. And like most European markets, residual values remain exceptionally strong for a long period following the pandemic and also the semiconductors supply crisis. And as a result, the market entered the correction phase later than its European peers. And Italy is now catching up with the normalization already seen elsewhere. Overall, we can conclude that the market has behaved largely as expected, and the adjustments we have seen during the first half of the year are consistent with the normalization process we anticipate.
Okay, so we are seeing some differences between these European markets, but I wonder, are we seeing the similar kind of varied performances when we narrow things down by powertrain?
Mm-hmm. Yes, although overall residual value movements remain relatively balanced across Europe, a different picture emerges when we look at our leading market indicators by powertrain. Let's take Germany as an example, as it is Europe's largest automotive market, and it often gives us an early indication of the direction the wider European market is likely to take. And we are looking at 3 indicators based on advertised used car listings, which are car age, stock days, and price changes. From top to bottom, starting with car age, which indicates structured trends of the market. And we see diesel cars, the red line on the market, are getting older, suggesting they are taking longer to find a buyer. And BEVs, the green line, show exactly the opposite trend. The average age of advertised vehicles, BEV vehicles, has fallen by 2 months over the last 3 months, only in 3 months. And the second indicator reinforces this picture is the chart in the middle, days in stock, which indicates market saturation and is often the earliest indicator of a shift in customer demand. Days in stock for BEVs, the green line, have dropped significantly, 11 days over the past 3 months and 20 days year on year. In just 1 year, BEVs have gone from being one of the slowest selling powertrains, as you can see on the left-hand side of the chart, to becoming the fastest selling powertrain since May. And naturally, that fits into our third indicator, the price changes, which indicates the desirability of the vehicles as well. And we see dealers are making fewer price reductions or changes on BEVs because demand is improving and vehicles are selling more quickly. This need has dropped by 70% in only 3 months. So what's behind this change? Not surprisingly, the recent increase in oil prices following the geopolitical tensions that intensified earlier this year, mentioned by Robert when setting the macroeconomic scenario, and the higher fuel costs have clearly accelerated demand for BEVs while reducing demand for diesel vehicles. We had energy crisis in the past. The last one, it was in 2021 and 2022, when electricity and gas prices mainly affected vehicle production costs, impacting the new car prices for all cars. But today's environment, the oil prices increase, is changing consumer behavior. Higher costs for diesel and, to a lesser extent, petrol vehicles are encouraging more buyers to consider electric vehicles, both in the new and also in the used car markets.
Yeah, and as you said, Anna, Germany can give us a bit of an early indication of the direction of the wider European market. So have we already begun to notice this trend elsewhere in Europe as well, where customers are leaning more towards EVs due to these higher fuel costs?
Mm-hmm. Actually, no, this pattern isn't unique to Germany. These charts we see are based on our price index from our residual value intelligence tool again, and we use February 2026 as the baseline, assigning an index value of 100 to each powertrain. And this allows us to compare how asking prices for diesel and BEVs have evolved relative to their own starting point, regardless of their absolute price levels. And the red line shows diesel asking prices evolution, while the green line represents BEV asking prices evolution. And let me start with Germany, the second chart at the top, since we have just analyzed this market in detail. And we see that since February, advertised BEV prices have increased by around 3% in Germany, while diesel prices have fallen by around 3.5%. Just to the right of Germany is France, and further down is Italy, when we observe a similar pattern, especially for the diesel movements. In the last chart, we have Spain behaving somewhat differently, as government is absorbing significant part of the increase in diesel cost, helping to support demand for diesel vehicles. And we haven't forgotten the first chart at the top, the UK. And in the UK, diesel follows the same downward trend, but BEV prices have been held back by a significant oversupply entering the used car market. In our view, these KPIs are leading indicators, and they tell us the direction of the market. And we expect this trend to become increasingly visible in residual values over the coming months.
Okay, so how have these factors affected our current forecast for the second half of 2026 compared to forecasts made at the start of the year? Now, just before I let you answer that, Anna, let's see what our audience thinks. We've had 53% of you vote for stabilization, 33% vote for a decrease. You expect there'll be a decrease, and 15% has said that they expect there to be an increase. So not many of you think that there'll be residual values rising. Anna, how do these results compare then to our market outlook?
Mm-hmm. Yes, of course, yeah. Despite the difference we are seeing at powertrain level, the overall market remains relatively stable, as the audience think, and aligned with the outlook we presented earlier in the year. The chart on the left shows today's residual values for a typical 36 months, 60,000 kilometer vehicle across the main European markets. And Spain continues to lead with an average residual value of around 54%, which is roughly 12 percentage points higher than Switzerland, the lowest market in this comparison. But to come back to your question, our outlook for year end remains slightly negative, let's say stable overall. The color coding highlights the expected magnitude of the adjustments. Markets shown in yellow are expected to experience only minor changes. Orange indicates markets where we expect residual values to decline by around 1 to 2%, while red identifies markets where the adjustment is likely to exceed 3%, where Italy stands out, as we currently expect a correction of more than 5% by year end. But it's worth noting that these forecasts are measured against December 2025, meaning that part of the expected adjustment has already taken place during the first half of the year. And of course, this is the overall market view. When we break it down by powertrain, the outlook becomes much more nuanced. As we have seen today, diesel and BEVs are already following different paths, and we will continue to update our outlook as these trends become more established.
And in light of this forecast, what should our audience be preparing for today?
Mm-hmm. Well, as always, reassessing risk is essential. Market dynamics are evolving, and it's becoming increasingly important to understand where your risk exposure lies, whether on the upside or the downside. Although the positive and negative trends are general in nature, there are differences from country to country in terms of the extent to which they are positive or negative, with a significant impact on business performance. Thus, cross-border imports and exports are also helping to rebalance market condition, reducing pressure in some markets while supporting demand in others. And we are already seeing manufacturers respond by adapting their new and also used vehicle strategies, reallocating supply and adjusting their commercial focus according to the specific dynamics of each market. In summary, in this environment, a more targeted market-by-market approach is becoming increasingly important.
Thanks for that, Anna. Now, I'd like to take a bit of a deeper look into one of the markets that we've already mentioned a couple of times already. But before we go any further, here is your final reminder to submit any questions that you may have to our Q&A, which is coming up right after the next section. Now, in Europe, it goes without saying that no two markets are quite the same, but the UK is particularly unique. To see how the market is currently developing, we don't just need to look back to last year or to the end of COVID, but to 10 years ago. Jason, why is this year and the trends that emerged in it key to the UK used car market?
Well, 2016 was a significant milestone for the UK's new car market because it produced the largest volume of registrations to date at just under 2.7 million cars. Now, from 2017, we see a gradual decline. We clearly see the effects of COVID, which are now well documented, and then we see the subsequent recovery. But it's interesting because some industry commentators suggest that really the true organic size of the market has always been around about 2.2 million, with all of those additional registrations coming from short-term business like rental. Also, kind of forced registrations or pre-registration activity was commonplace back then. But whatever you believe the true size of the market was, between 2020 and 2022, somewhere in the region of 2 to 3 million new car sales were lost forever. And as a consequence, we now see a lack of 3 to 5-year-old cars in the used market, which has led to relative stability in RVs in kind of recent years.
Okay, but that begs the question then, why did we see a decline from 2017, not just when COVID-19 hit the UK in 2020?
Basically, we saw a drop-off in diesel. Now, the red portion of the bar chart that we see represents diesel volumes. The blue is petrol and the green is alternative fuel vehicles, so a mixture of electrified models. So the drop in diesel coincided with Dieselgate and the subsequent negative press that was surrounding that. We saw petrol and alternative fuel vehicles increase a little, but it was not enough to cover the drop in diesel. Now, during this time, we begin to see the meteoric rise of electrified models, and in particular, the rise of BEVs.
And what led to this surge in BEV registrations exactly? Was it affordability-led, policy-led, or just advances in technology?
Well, it was driven by company car demand. The UK government surprised the market by lowering benefit-in-kind tax rates pretty much overnight in April 2020 to zero. Now, benefit-in-kind taxation is a taxation levied on an individual who is deemed to have gained a benefit from having a company car. Now, back then, diesel company cars were still pretty common. And at that time, drivers were typically paying between £300 and £500 per month in benefit-in-kind taxation. Now that went to zero. So I think at that time, whilst many people were probably still not ready for a BEV, they were certainly ready for a free one. Okay, add to that greater choice, improved ranges over time, and improved technology, and quite honestly, some very cool cars, and couple that with some fairly strict targets laid out by the government in the form of the ZEV mandate, and we have seen year-on-year increases ever since. It's interesting, actually, if you go back to 2016, just over 10,000 BEVs were sold. In that year, more motor caravans were sold in the UK than BEVs. And then we see last year, obviously, we're well into over 473,000. So a massive turnaround.
I think that's a bit of an understatement. Yeah, what an incredible statistic. Okay, now we've looked at the UK new car market and the reasons why it began a downward trend before COVID-19 hit. But how were residual values performing at that time?
So if we go back to 2019, RVs were in decline. The used market was oversupplied and demand was not great. However, it began to improve at the back end of that year, and actually dealers were quite upbeat going into January 2020. The wholesale market in the UK, in fact, was very strong right up until the first lockdown. Now, throughout 2020, RVs actually were on an upward trajectory, and that was due to a lack of supply. There were, we all remember the logistical issues associated with COVID, and it really prevented people from changing their cars, and that affected the flow of used car stock into wholesale channels.
All right, let's now widen the date range. How have residual values progressed since that point?
Well, the big thing to note is we saw a very large uplift in values throughout 2021. We've already seen that there were supply issues affecting the new car market, and this led to quite a lot of contract extensions and therefore a lack of defleets, which affected used supply. This was then combined with really quite high demand. So basically demand outstripped supply and RVs went up. I mean, if we overlay all fuel types, with the exception of BEVs, they're now closer than ever. Yes, there's a recent spike in diesel values, but the volume of 3-year-old examples in the market is now so low, we shouldn't read too much into these fluctuations. But if we do look at BEVs, during COVID times, they actually rose broadly in line with the average. And why was that? Why were they so strong? Again, it comes back to benefit in kind taxation. Because the supply of BEVs was poor in the new car market, people who couldn't get hold of one, they were turning to the used market to get a BEV so that they could still benefit from a zero benefit in kind tax. But the BEV decline has been more severe since then, and we clearly see they are now significantly lower in percentage points terms. Thing is, improved supply in the new car market combined with a large increase in supply in the used market led to a real sharp decline in RVs. I mean, they're still in high demand today. There isn't a major issue, and they are regularly the fastest selling fuel type. They just seem to have found a new level.
And I want to look in a bit more detail now at the metrics that determine these residual values. How have used car prices and new car prices trended in this period?
There are some powerful visuals that are available to us using JD Power's residual value intelligence application, as Anna mentioned before, and they can really help. I mean, again, if we focus on the average RV of a 3-year-old car at 60,000 kilometers, we see some significant changes in used car values over time, together with big shifts in the new car pricing as well. So it's interesting, if you look at the chart on the left, if we compare the point at which values began increasing significantly at the beginning of 2021 with now, RVs are still 0.8 percentage points higher, albeit they've been on a big roller coaster in between. But it's interesting when you look at the pound note amount, they remain over £3,300 higher. And then if we look at list prices on the right, it's staggering to see the increase in list prices. I mean, if we look at the same metrics, but just for battery electric vehicles, when RVs are expressed as a percentage of list price, they have, over that same time period, they've fallen 3.8 percentage points. But in absolute terms, in pound notes, they're still over £1,900 more than where they were. Now, cost prices are a little bit more erratic, but again, they are clearly on an upward trajectory.
Okay, so where do we expect residual values to go from here then? Will they continue to normalize, or will we see a period of stability?
I think, well, what we can do, we can look back at the past to get an idea of the future. We know there is a link between registration activity in the new car market and RV development some years later. Now, in 2019, there was a high volume of 3-year-old cars entering wholesale channels, and as a result, we saw a dip in RVs. It's worth remembering that typically 85% of new cars are actually financed in the UK. And back then, many were leased or on PCP finance deals on a 3-year term. So most will come back into the market. We already saw that 3 years earlier in 2016, it was a record year for registrations. So it seems that there is a correlation.
Okay, so to figure out how residual value should develop in 2026, we need to look back at 3 years prior.
You're on the right track, but not exactly, because if we fast forward to present day, contracts are usually longer now, typically 4 years, and this is due to affordability, because as we've seen, new car list prices rose significantly during COVID times and beyond, and the cost of borrowing is also higher now. So to get an idea of potential used supply at the back end of this year and into next year, we need to look back at new car sales in 2022 and 2023. Now, we've already seen this is where the market suffered a dip. It's therefore reasonable to assume that we will not see a significant rise in supply throughout the rest of 2026. And although in 2027 we might see an increase, we don't feel it will be significant enough to negatively impact the supply and demand balance. So as long as demand remains consistent, which we expect it will do, there should be continued residual value stability. We do expect a very marginal decrease in RVs, but no significant bumps in the road.
Thanks, Jason. Well, I think that brings us on quite nicely to our Q&A section. We've had some fantastic questions sent in, but please do keep posting them in. If we can't respond to your question today, then we will be reaching out to you by email after the webinar. So, Robert, I think I'll come on to you first. I've got a question here for you. Which macroeconomic variables have the highest potential to change forecasts going forward?
That's a good question, and I think the main influencing factors are inflation rates coupled with interest rates, as they have a high near-term impact. Automobiles are heavily financed products, so the vehicle demand is also sensitive to borrowing costs, and higher interest rates that often follow situations of higher inflation, they translate into higher loan and lease payments, and this then again affects the market demand. And on the supply side, also the suppliers are confronted with higher labor costs, higher logistic costs, supply costs in general, higher energy costs, and this again leads to higher prices. So inflation and interest rates, I think, are the main macroeconomic factors influencing the industry.
Thanks, Robert. And we've got another forward-facing question here for you, Anna. How should the fleet and finance industry interpret the outlook for 2027? What can we expect specifically from BEV residual values, and is it likely that they will continue to rise?
Okay, yeah. The answer is yes, to some extent. After being one of the most heavily impacted powertrains over the past few years, the BEVs are finally benefiting from a more supportive market environment, which is actually easing the pressure on residual values. Then we therefore expect this positive momentum to continue over the coming months. However, over the time, the market is likely to rebalance as a growing number of BEVs will enter the used car market, increasing supply.
Thanks, Anna. And one for you, Jason, now kind of returning back to our UK deep dive section, if you will. Will the same trends that we've seen in residual values continue in the next couple of years? So could incentives and regulations, maybe such as the ZEV mandate, play an important role in determining residual value development?
So I think, as I've said, in the short term, with supply and demand well balanced, we don't expect a significant change in trends, but there is some uncertainty regarding regulation in the UK, and as you point out, particularly the ZEV mandate. Now, for those who don't know, this mandates the percentage of registrations that must be BEV. So in 2024, this was 22% of all OEMs registrations. Last year it was 28%, and this year it's 33%. Now, this rises year on year all the way to 2030, where it will be 80%. Now, to date, this target has not been met overall, and the penalty is currently set at £12,000 per vehicle that is short of the obligation, so it's pretty significant. But there are a number of levers that OEMs can pull to avoid these fines, like they can borrow credits from their future years kind of allocations to cover shortfalls now, and they can buy surplus credits from OEMs who have overachieved. But in just 2 years' time, that target will have risen to 52%. Now that could lead to a push market as OEMs push to avoid severe penalties. This is likely to put BEVs under quite a lot of pressure in terms of RVs. So a relaxation of these targets could lead to more stable BEV RVs. So either way, any uncertainty is not good for OEMs, as it can take significant effort to change production planning. But I think we can understand why UK government is under pressure to relax the quite harsh targets.
I think it's certainly always interesting to look at how regulations and also incentives in the new car market are affecting the used car market and residual values. We've got a question along those lines here for you, Robert. Many residual value discussions reference list prices, yet the real market is increasingly driven by transactional pricing, manufacturer support, and government grants. To what extent do you believe aggressive new car transaction pricing is now having a greater influence on used EV residual values than the underlying product of or consumer demand?
I think that that's one of the really most important factors here, because whatever is incentivized in the new car market translates directly to what we can observe on the used car market, specifically for young vehicles. So if there is heavy incentives, for example, for BEVs, coming either from the OEM strategy or regulatory pressures or government incentives, it kind of immediately reduces the RV in percent, as we measure this against the list price usually. So it's true, transaction prices, like the discounted prices, are the main influencing factor, mainly for young used vehicles. And whenever there is more incentivization, we can see pressure, especially on young used vehicles, and that's what also happens in the market now.
Thanks, Robert. And I think we've got time just for one more question, and I'll pass this one over to you, Anna. What trends are you currently noticing in residual values from Chinese brands?
Okay, that's a recurrent interesting question. Residual values for new entrants have been evolving and are increasingly on a par with those of traditional European brands, and also as well as with other Asian brands. However, this varies from country to country. In Germany, for example, where German brands carry significant weight, the average difference is still around 5 points, whereas in countries such as Spain, a country where Chinese brands have already achieved 10% market share and are continuing to grow, RVs are now more closely aligned, and the difference may be around only 1 percentage point. But having said this, it's important to know that the new players usually don't start from this position. While new entrants are competitive from a product perspective, residual values are influenced by much more than the product itself. Brand perception, purchase intention, distribution strategy, and more important, used car management, all of them play a significant role. That means building strong residual values takes time. And even with a competitive product, it requires consistent execution and a long-term strategy to establish customer confidence and consolidate residual values.
Thanks for that, Anna. Unfortunately, that's all the time we have for our Q&A. And in turn, that also means we're out of time for today's session. If you would like to explore any of the products referenced today in more detail, then please visit autovista.com/explore. And just a reminder that a recording of this webinar will also be available on the JD Power YouTube channel. All that's left for me to say then is a big thank you to the panel for joining me today. And of course, a big thanks to you, our audience, for joining us and submitting so many thoughtful questions. We hope to see you in our next webinar, but it's goodbye for now.